Well, we have a packed house. Very good morning to those of you here at the DIFC in Dubai, and to those of you joining us from around the world. You are most welcome. I'm Becky Anderson. For those of you who don't know me, CNN's managing editor in the region and host of the network's primetime nightly news show program from our Middle East broadcasting hub in Abu Dhabi. Thank you all for joining us for this discussion focused on the IMF's regional Middle East and Central Asia economic outlook. Following a very challenging 2021 for countries in the region, in MENA as elsewhere, growth surprised on the upside in 2022, supported of course by a rebound in oil production and tourism, as well as robust remittances. But, big but, inflation continued to rise in the region's emerging market, reflecting the impact of past exchange rate depreciations and persistently elevated food prices. So, what is in store for 2023 and beyond? Last month, the IMF lowered its global growth forecast for 2023 and described the global economy as facing a rocky recovery. And it projected GDP growth in the MENA region will slow to 3.1% this year from 5.3% a year ago. And we know that the growth picture amongst MENA countries is very varied. Oil exporters clearly have a very different growth picture than that of emerging and and particularly low-income countries in the region that are forecast to lag significantly as recurring global shocks, high commodity prices, macroeconomic instability, and country-specific fragilities weigh on their prospects. So, to discuss the outlook and to examine what policymakers can do to safeguard macroeconomic stability amid uncertainties in the Middle East and North Africa, I'm absolutely delighted to be joined today by a terrific panel. Jihad Azour is the director of the Middle East and Central Asia Department at the IMF. You will have, many of you already heard from him this morning. This is a really good opportunity for a deep dive on the regional economic outlook and a sense from our other panelists of their perspective on the region. Khatija Haque is Chief Economist and Head of Research at Emirates NBD. Mahmood Pradhan is the Global Head of Macro at Amundi Asset Management, and Ms. Ebru Pakcan is the Managing Director, Head of Middle East and Africa Cluster, Citibank UAE. Some housekeeping. We will open the floor for questions about an hour from now. To those of you here, please do raise your hand, and for anybody watching online, you can post questions on social media using the hashtag at IMF MENA. The communications team here will bring those in and they'll get them to me, and we will get to as many of those questions as we can. This is your panel discussion. I'll take a lead with the panel as we kick this off. Certainly the open floor discussion is absolutely critical to the success of this, as I say, as we take a really good deep dive. Before we hear from our panelists, I would like to introduce one of our hosts today, the DIFC's Executive Vice President, Ali Al-Zuruni. Please put your hands together.
Good morning, ladies and gentlemen. It is my pleasure to welcome you all to the launch of the May 2023 IMF Regional Economic Outlook Report for the Middle East and Central Asia region. IMF reports are highly anticipated. I personally look forward to these reports. They provide in-depth analysis on the economic outlook of the MENA, highlighting opportunities and challenges for countries in this region. It also offers practical policy recommendations that these countries can use to help them develop and achieve sustainable and inclusive growth. So looking back at 2022, we have seen excellent positive growth in this region. Banks are reporting excellent and strong numbers surpassing their expectations, and this applies to many other sectors as well, such as tourism and trade. In fact, the DIFC authority has reported a record year of record results in 2022. We were able to break for the first time in our history the 1 billion mark in revenues last year. We had the highest number of registered entities in a single year, accompanied by the highest FTE growth in a single year since inception. On the other side, the UAE, as an oil exporting country, reported positive growth and continued and still continues to focus on diversifying its economy to boost revenues from non-oil sector. And that is obviously because our government plans for the future with a long-term view to ensure economic resilience and agility. So I'd like to stop here. I'm sure you're all waiting to hear from Dr. Jihad and panelists. Before I end my note, I just wanted to say that the launch of this report is an important event, and I would like to thank the IMF and Dr. Jihad and his team for their continued commitment to supporting the economic development and stability of the MENA region. I also want to thank the IMF for their long-standing partnership and relationship with the DIFC. Thank you all for joining us today, and wishing you all a successful and productive event. Thank you.
Thank you very much indeed. Okay, you'd just like to come and join me, Jihad, Khatija, Mahmood, and Ebru, if you'd like to come and join me on the stage. And ahead of our into the Q&A session. You raise your hand, name, organisation to our guests. We'll take your questions in. I'll take as many as I can. And for those of you online, again, you are more than welcome. We very much look forward to your participation. I'm going to stand away. You can take this away so the audience can get a sense of who we are and what we're doing up here, and we will carry on. Can you hear me on this? Yes, you can. Great. All right. Thank you, everybody, joining us on what is an absolutely beautiful day here in Dubai. Jihad, let me start with you. While many economies proved resilient in 2022, they are clearly grappling with the consequences of the sharp policy tightening that we've seen over the past year, lower oil production, as well as renewed global financial vulnerabilities. How do you see the challenges facing MENA countries and their outlook for the next 2 years? I want to give you a moment to give us your perspective before we open the floor for a further discussion.
Thank you very much. Good morning, everyone. Yes, good morning, everyone. Thank you very much. I would like again to thank the DIFC for this excellent partnership. We have been for more than a decade working together on promoting macroeconomic developments in the region, as well as also promoting the change that is taking place in this part of the world. This year is a bit a tricky one, Becky, the least to say. Of course, we hear the word of uncertainty now coming more and more often. I see three types of issues or uncertainties. The global ones that are affecting the region. And here the turbulence we saw in the markets have had so far limited impact, but this is an issue that to keep watching. The tightening of monetary policy globally had to be reflected in the region, both for oil exporting, who have fixed exchange rate, but also the others too, and the impact of that in terms of capital flows, both interest and investment. This is the second global challenge that is affecting the region, as many other emerging economies. It's affecting the countries differently, and here where the second layer of challenges differentiate countries. Policies matter this year more than ever, because you don't have the same trend in terms of liquidity and, I would say, positive market conditions. Therefore, there is greater differentiation. Policies are important, and the one that is more important than previous year is the monetary policy. Why? Because inflation has proven to be strong and persistent over the last 3 years, requiring further tightening in order to address the issue of inflation, but also to increase the level of credibility of monetary policy. It's about tightening, also it's about the instruments that are being used. The other important policy dimension is the interaction between fiscal and monetary policy. Of course, this is different between where countries are, but it's more relevant, especially in countries where debt is high. And this is, I would say, why policies are important in their timing, in their interaction, and their ability to project confidence in the market. The third level is the other issues. And here I would like to highlight, there are many, but I would like to highlight two. Fragmentation is clearly something that has affected all parts of the world. But geopolitical issues are important in this region because there are certain external ones that last year, for example, the war in Ukraine had a bigger impact on some countries of the region than neighboring countries. I cover also Central Asia and Caucasus. And it was very interesting to see that economies like Georgia, Armenia, that are very much dependent on Russia, growing faster than some of the economies here, or less affected negatively by that. Why? Because import of certain number of commodities is very important in the region. Therefore, geopolitical issues, fragmentation is important, but this is also could offer an opportunity we will discuss this later. But geopolitical and fragmentation are important issues. The second important element is certain number of effects. And I would like to take one as an example, which is climate. Climate is becoming more important, both because of its impact. Temperature is rising in the region, and it's increasing the level of vulnerability. The region is also in the big transformation in terms of energy mix. We have the COP, for example, 28 this year in Dubai. Therefore, those elements are of structural natures, but are important. Therefore, we have three layers, I would say, of challenges that need to be addressed. To summarize it, that is going to be important. Access to finance, access to market is also very important. Social stability, because when you have high level of inflation and growth is slowing down, it hurts those who are on the low end of the social pyramid. And last but not the least is the ability to move very quickly in terms of adjusting policies. And here, I think countries have performed differently. And I'm sure we will discuss. There are questions on a certain number of countries that will show that countries perform differently based on the policies that put in place.
Thank you. I just want to pick up on 2 points. We'll certainly perhaps discuss a couple of points with you before I open up the floor to the wider panel. The first question is this. These IMF projections that you announced in April and that are embedded within the outlook for 2023 reflect developments prior to the last OPEC plus oil production cuts. How do you expect those further cuts, given what you've just said, how do you expect those further cuts to affect the regional economic picture?
Oh, thank you for clarifying this point. Of course, the impact is different. The increase, the drop in demand, so the drop in production will definitely reduce the growth of the oil sector. And this is why when you look at the numbers in 2023-24, you see, which is the good news for all the countries, especially in the GCC, that the growth in the non-oil sector is stable and it's strong, relatively 4.5%, which is a reflection of the various reforms that were introduced over the last 5-7 years. You will see a drop in the oil sector. This is one element. The other element is if this will show stabilization of oil prices, this will reflect positively on the revenues and will improve the situation of the budget or the public finance. For the oil importing countries, if this will translate into increase in oil price, this will have negative impact both on their balance of payment, external account, but also in terms of the prices. Again, this is part of the equation. What will determine oil price is also depending heavily on the recovery that we are seeing now and how strong this recovery is in Asia, because the demand is playing an important role in the definition of the market equilibrium price.
Okay, thank you. I have a question very specifically on Sudan, but as you rightly pointed out, I think we will get a lot of country-specific questions as we move through this next hour and a half. So I'm going to leave my question on Sudan to kick off perhaps the Q&A part of this process. Let's then just remind ourselves, for this part of the panel, we are looking at two themes, I think, that come out of what you just said: recurring global shocks and policy trade-offs. And you've made the point that policy decisions will be more important than ever in 2023 and beyond. Khatija, let's just pick up on monetary policy then. Given what you've just heard from Jihad, has the monetary tightening so far been sufficient and has it been effective, or are there factors undermining its transmission to the real economy?
I think most people would agree that there is quite a significant lag between when monetary policy is tightened and when you actually see the effects in the real economy. For the GCC countries, we have imported the interest rate hike peg currency. So when we look at policy rates in the region and we look at inflation in the region, which is actually quite a lot lower than in the United States, we're already in a situation where we have a positive real interest rate environment, a tight monetary policy environment. However, there is a mitigating factor in terms of the transmission of that monetary policy into the GCC, which is that oil prices also affect liquidity in the banking sectors here. And we've seen that in the last 6 to 9 months, where we've had, well, in fact, all through 2022, sharply higher oil prices, oil revenues coming into the banking sector, and mitigating some of the impact of that interest rate tightening. So when we look at the spreads of the interbank rates in the UAE, for example, they've actually tightened more than we would have expected given the rate hikes that we've seen in the United States. And to some extent, it's also affected by the demand for credit in the local economies. And there is quite a big difference between the demand for credit that we've seen in the UAE, which has been quite low, relative to the demand for credit in Saudi Arabia, where businesses and government are investing very heavily in some very big infrastructure projects. So we've seen credit conditions tighten in Saudi Arabia, and we've seen them loosen somewhat in the UAE in terms of the liquidity. So those can affect the impact of higher rates, because if they're not fully passed through, then obviously you're going to benefit in some way. But I think overall, the GCC doesn't need interest rates to be as high necessarily as in the United States, because we are not seeing the kind of inflation.
Do you see the rate rising cycle as having plateaued at this point?
We expect the Fed to have another 25 basis point hike this week, and then we do think that there will be a pause in terms of rates going forward until we have a better judgment on how effective that has been on the real economy in the United States. Again, even the Fed would argue that it takes a year or more to have rate hikes impact the real economy.
Thank you. You talked very specifically about the GCC. Let's open this discussion up to a slightly wider perspective and include the emerging low-income markets if we can. What is your perspective on the monetary tightening policies that we have seen across the region, and what you believe the prospects are for the region's emerging markets in securing external financing at times of high debt, elevated uncertainty, and tightening global financial conditions? As an aside, or perhaps as an addendum, how concerned are you about the global financial stability? I'm talking about the financial sector as a whole here.
Yeah, thank you. Thanks so much. Let me start with where I'll come back to global financial sector worries in a minute. But let me start with the external environment. I think the first place to start is we look around for the emerging market world as a whole, and I'll come back to the region. So the external environment has clearly been not very favorable for emerging markets accessing global markets. So I'll start with a couple of numbers. 2020 was probably a very good year for emerging markets, despite the pandemic, for raising money. Emerging markets as a whole, just in terms of debt issuance, raised something like 240 billion. 2022 was probably one of the worst years, directly related to your point about global financial conditions tightening, where monetary policy in the advanced economies was, we had an inflation shock, and policymakers reacted. So 2022, global debt issuance by emerging markets was about 97 billion, less than 100 billion. 21 was a little bit more. Now, where are we now? So far this year, it looks like we've had a reasonable start. Okay? There is some recovery. So we're running at about 50 billion so far. So we could end the year somewhere about 100, a little bit more than 100. So that's kind of just to give you perspective of where we are for emerging markets as a whole. Secondly, if we start looking at what could be the medium-term prospects for emerging markets, there are two factors that I think are relatively favorable, and I mean the medium term. One is that the growth differential between emerging markets and the more developed markets is actually narrowing, okay? And here I'm talking about, secondly, once we get over this inflation shock in a period, it may take some time, it is quite likely that interest rates will fall again and borrowing costs will stabilize, okay? So that's all the positives. Now let me come back to the region. Here, there are some very worrying trends in the region. When you look at what the IMF classifies as middle-income emerging market economies that typically access global capital markets, and it's primarily debt issuance rather than equity. Okay. There is a very worrying picture. First point is that a few countries, there are really exceptions, like Morocco and Jordan, that have been able to access markets. And broadly speaking, without getting into details, they have better macro balances and their public finances are in better shape. Okay? The pandemic has been and the war has had a very large shock on this region in terms of financing. If you look at the IMF's projections for the debt burden that these countries are carrying, we're going to be about 10 percentage points of GDP higher at the end of 24 than compared to the pre-pandemic period. So we're going into what I describe as a slightly favorable medium-term environment, but with a much higher debt burden. Okay? The fiscal adjustment required, that again, I'm just using the IMF's projections, is about 4 percentage points of GDP. So we have an issue here for a large number of countries raising capital. I want to make a third point, which is how are markets going to look at this region? One of the factors we've seen during this unusual period of tightening, it's been inevitable that a number of countries in this region have accessed domestic capital markets, and very specifically domestic banks. Okay. There's a very large, again, using the IMF's report, it varies a lot, but it's close to averaging around 50% of government funding has been raised by domestic banks. To give you a comparison, that figure is about 15% across the emerging market world. So it is very high. Now, it's understandable and inevitable, but there are consequences. One is clearly the worries that many people have when they look at the global financial crisis, the very close links between states and their banking systems. That's always a worry. Secondly, and in particular in this region, with underdeveloped capital markets, this has a cost. This actually is crowding out funding for the private sector. Okay. Now, that is another challenge. All of this comes back to what do you do about it? Fiscal consolidation, etc., fiscal adjustments. And there are lots of things that we can talk about of what governments might need to do to address this dilemma.
And we'll get to that. Yeah, and then that's the sort of, the second theme of this is really what can policymakers do to ensure the resilience, as it were, of these markets. I do just want to get Ebru to pick up on a couple of things that you said, not least the risks, the potential risks from governments' over-reliance on financing from domestic banks. I mean, first of all, how can additional bouts of financial stress be transmitted through these regional economies? And just how concerned are you about these risks and how might they be mitigated?
Okay. So, and I'm going to start with the US. I apologize I didn't answer your question.
Let me bring up Ebru, and then I'll come to you, back to you.
Welcome to answer.
Sorry.
But let me maybe just step back for a second before we touch upon the government securities and the risk that's associated with that, which is clearly phenomenon for the emerging markets that we're talking about at the moment. But if you just think about the last few weeks and some of the financial crises that impacted banks starting on the West Coast, coming towards this side of the world, what is essentially very important is the management of liquidity and capital. So very basic, but that's how banking industry thinks about managing its risk. Now, while that's a far end of the world, what we've seen with the Silicon Valley Bank example, for example, was a combination of business model challenges, which was very concentrated in one particular client segment and in one particular industry. When I do the comparison to a lot of the banks in Middle East and in the particular region that we are talking about, the business models that we are comparing are very, very different. Banks in Middle East and in this particular part of the world are a lot more universal banks. They have a very diverse client base, all the way from retail to institutional clients. And that's one big obvious difference in terms of how funding and liquidity management is a mitigant in terms of thinking about the liquidity risk that we're talking about. Second point to make is around that asset and liability management in equilibrium. And clearly when we look at the example of SVB, again, we see some quite basic practices that are being lacked in that management. Now, trying to make a parallel for this part of the world and banking industry and the regulatory environment, it's a lot more of a level playing field and a uniform banking regulation that applies to banks in this part of the world, which very clear capital requirements, liquidity and funding ratios, etc. Now, obviously that varies from economy to economy or country to country and what type of government waivers and exemptions exist. But again, in comparison, I think typically we would find the banking regulators to be quite strong in terms of the practices and management that they have adapted. There's always more that can be done from a stress testing perspective, from a liquidity and capital management perspective. But those are some fundamental differences that we need to think about when we are thinking about the banking industry in this particular geography versus some of the things that we've seen elsewhere in the world. The dependency on domestic securities or the investment, heavy investment that has been going into domestic securities and government bonds, which is highly encouraged, obviously, by the governments as well, is a challenge. Mahmood just touched upon that. Having said that, again, some of the things that we need to think about in that respect is, if you look at the unrecorded losses, actually on average, in GCC especially, 10%. And that is assuming that there is good hedging practices and matching deposit tenors involved in the funding. That is not an unsurmountable percentage. But I'm noting there is a caveat there in terms of risk management and hedging practices that the bank must have been deploying. And to the extent that those are in place, against some of the increasing interest rate shock, there is going to be appropriate mitigants and factors there. I guess we'll probably go on to talk about some of the policy measures that can be considered. So I'm not going to dwell on that immediately. But I do want to flag another point, because I find, and especially I guess on this forum, I may be the only non-economist and a business person who's concerned with not only financial risks, but non-financial risks, which can be hugely important in the banking industry, because essentially it's a trust and confidence business. And a lot of bank failures eventually stem from lack of liquidity or a sudden loss of liquidity. And when I think about that, actually operational resilience matters. cyber security matters, unforeseen, unanticipated climate events, whether that's the impact of floods, whether that's the impact of droughts, whether that's the impact of an unforeseen war. Those are very significant events. And reputational risk that can go hand in hand with those events, or other regulatory or otherwise mishaps, can be very, very daunting for banks. And actually in today's world, with the available technologies, a bank run happens a lot faster and in much greater scale than it used to happen maybe 10 years ago. So that's a different angle that I wanted to bring to the conversation beyond some of the financial risks.
And it's a really important one, and it's no bad thing that we have a non-economist on the...
On this panel, thank you. That perspective is hugely important. Value as we work through the policy trade-offs then, Jihad, you've just heard from our esteemed panelists, their perspective on where we are at. As we work through what is a region that shares the sort of concerns about inflationary pressures that other parts of the world do, while trying to mitigate financial stability risks stemming from tightening domestic financial conditions. How do policymakers strike a balance at this point?
Okay, this is, in fact, it has been raised by the panelists. This is going to be the main important trade-off this year. Our research showed, let me start with what hurts most, which is the monetary policy issues. That few things. One is the time lag. Khatija mentioned it. There is a longer time lag from moving on the monetary policy and seeing the result, which is on average 1 to 2 quarters longer than what we see in other parts of the emerging markets, which requires that, which means that it will take more time for the policies to show results. Second is to be data-driven, which is very important. I think this is something that it's important in terms of having the right ability to read and project confidence in the market. 3 is the impact of the instruments. The transmission mechanisms are very important, and this is where the coordination between fiscal and monetary is important. You cannot increase rates at the same time you have other avenues of providing liquidity to the system, be it by deposits or by certain lending schemes. Therefore, it's very important this year to scale up the capacity in terms of monetary policy. Debt. Clearly, the level of debt has increased. And the debt is becoming more challenging because in terms of amount is more important, but the cost also grew. On average, you have an increase between 1 to 3% of GDP only because of increase in the size of debt and interest rate in terms of debt service. This means that we need to maintain fiscal consolidation and we need to make expenditure more productive. Here, it's a must to rechannel financial resources to focus on the most vulnerable groups through a better targeted approach and gradually exit the old system of untargeted subsidy that is very expensive. 3, the stability of the financial sector. Also, when the market events happened in the US, you look at the situation in the region, the immediate impact is limited, very limited exposure on the 2 banks that faced issues, but yet we still are in a situation where we are unlocking some of the measures that were introduced during COVID in order to support the economy. Therefore, it's very important to have a kind of more scrutiny in terms of what is in the balance sheet that needs to be repriced or assessed. The nexus between state and markets, Mahmood alluded to that. It's a very important issue. Clearly, this provides the capacity to access to financing, but this also has an impact on the balance sheets and the strengths of the balance sheet of the banks, but also on their ability to finance the economy. Deepening the local financial markets is a step that could help in this direction. Broadening the type of investors is also something that require policy actions. Again, I think this year is a year where you need to move fast, and this is something that we saw. Clearly, in markets where you have flexible exchange rate, you need to make sure that this flexibility is credible to the market and credible to investors. And at the end, we need to start thinking about what will create growth in the future. Because we are growing at a pace that it will not be enough to address the unemployment that grew on average between 1% to 3% because of COVID and the last 3 years. And it's not enough in order to improve income of population. Therefore, also, it's the time to look at some of the structural reforms that will benefit the medium to long-term growth.
And let me just pick up on the structural reforms. And as we look at the oil exporting countries and look to the preponderance of growth from the non-hydrocarbon sector in this year and next, what further fiscal structural reforms do you think are necessary at this point? And do you see appetite for those, picking up on what Jihad has just suggested?
I mean, I think the extent of fiscal reforms in the region, in the GCC specifically, over the last 5 years has been phenomenal. So they've introduced new taxes, they've made those taxes, in some cases, apply to a broader range of taxpayers. There's been a focus on efficiency of spending, which I think is key, trying to curb the growth in current spending in the region, so wage growth, trying to encourage people to move into the private sector. In terms of further fiscal reforms, I actually am of the view that broader economic structural reforms that boost private sector participation and growth and investment are actually what's needed to put the budgets on a more sustainable track as well. I don't think that it's necessary to raise existing tax rates or to introduce new taxes. But I think on the spending side, there is probably still work to be done on subsidy reform, perhaps price caps on certain goods and services. But more broadly, I think if the GCC economies simply implement what they've already announced in an effective and transparent way, and then focus on reforms that grow the private sector, whether it's reducing transaction costs, ease of doing business, the costs of employment, for example, here is still quite high. Those are the sorts of things which I think overall would benefit not just the broader economy, but the budgets as well.
Let's just pick up on, again, on this policy trade-off story specifically. You talked a little bit earlier about this, but I just want to drill down a little bit. How should the region's policymakers strike a balance between the benefits of relying on domestic banks and the risks of over-reliance? Where do you see policy trade-offs and shifts, if necessary?
Sure. And like you say, we did start touching on this. I mean, typically what you find with domestic sovereign debt, if you look at the regulatory framework, the risk weightings or the concentration or exposure limits, which are applied by regulators in domestic markets, are much more favorable compared to other forms of exposures. And that's one of the reasons typically you would find a lot of domestic banks, especially in those markets where there isn't depth and breadth of capital markets, being quite heavily exposed to government debt and sovereign debt. Now, there are obviously some regulatory framework-related policy changes that could be thought about, and that ranges from some concentration limits, some more risk weighting, encouraging perhaps less investments into government debt. But the real answer is actually something which cannot be done overnight, which is around investments into a much broader domestic institutional investor base, and developing that domestic institutional investor base so that it's not really only the banks, but a much broader financial services market who's investing into such government debt. But in addition to that, deepening and broadening the capital markets itself, so that banks actually have more avenues in terms of exposures and asset side of their investments that they could be going after. Unfortunately, this is very limited if you think about the geography that we are talking about. GCC countries are further ahead in terms of building out those capital markets and the institutional investor base. But for the rest of the emerging markets that we're talking about, it's very limited. Israel is the only other place where there is such depth of capital markets, which is obviously very helpful. So this is a long-term investment that will need to be considered. The final thing that I want to mention on this, and Dr. Jihad actually touched upon that, it's the linkage between monetary and fiscal policy. And we see actually quite a few mishaps or results of uncoordinated efforts, ranging from the fiscal policy, which is trying to attract a lot more foreign direct investment into the country, especially in those more import based markets, trying to reduce amount of imports. But then that doesn't really talk to right hand of the policy, which is looking at the foreign exchange policy and the monetary policy, and creating a lot of squeezing of foreign exchange in the markets, which is in fact actually impacting the exporters themselves. So that coordination, that dynamic between fiscal and monetary policy is hugely important in terms of actually helping banks, which also need to continue to provide borrowing capabilities and credit capabilities in these markets. Again, hugely important for small, medium enterprises or other corporations to continue to actually turn the wheel. And there are incentives, obviously, that governments are thinking about, and during COVID-19 crisis, some of those government support has been hugely important. But in this environment, with the amount of uncertainties that we have, that might become a trap within itself. So that's another dynamic that needs to be watched very carefully.
Mahmood, let's talk about this from a market perspective, thank you, and where you see the low-hanging fruit that the region can rely on to help mitigate the impact of what is, I think we all agree, a tightening macroeconomic sort of picture. And where do you think the key reforms are on policy, which you genuinely believe need to see enacted at this point?
Okay, thank you. I'm going to start with the macro, because I think macro is really important. The stability is really important for kind of being an attractive market. So let me just start from where we left off on the banking system exposure. The fact that you can access domestic banking systems when your public finances are stretched is a good thing. Clearly, it was necessary. But it's not something that foreign investors ignore just because you're finding domestic finance. The total debt and the health of public finances matters. So this is something to think about. But coming to your question. And I'll try and relate why I pick a sequence. First, I think inflation control is really important. So being what Jihad was saying, kind of designing macro policies or persisting with some restrictive monetary stances that deliver low inflation. It's really important for some of the countries in this region, which we have seen have faced very large exchange rate depreciation pressures. Inflation and fiscal is at the source of that. They're constrained by the amount of foreign reserves. So I'm not going to call it low-hanging, but it's actually imperative. Secondly, in much of the world, through the pandemic and the war, you will see this notion that fiscal support should be targeted to the vulnerable groups. Okay? Think about, this is really difficult even in advanced economies. They have not done it. Targeting is not as simple as it sounds, okay? It may be because of the scale of the shock that the world faced, but it's actually very difficult in advanced economies. Now think about this region or similar economies where you're targeting support. What is the support people need? They need support for higher energy prices, higher food prices, okay? These are, in less developed economies, both of these items are very large components of the average person's consumption basket, okay, compared to the developed economy. So, in order to make targeting fiscal policy to fiscal support to the vulnerable, to make it tenable or viable, you actually have to try very hard to control inflation as well. Otherwise, you're not going to achieve it. Let me stay with the fiscal in terms of low-hanging fruit. One is a better enforcement of tax policy. I understand that we're not talking about higher tax rates, but enforcement of tax policy or limiting evasion, collecting more revenues at the same tax rates is really important, because the health of the public finances is what needs to be fixed, okay? Following on from that, transparency of what the state, what governments are involved in terms of their economies and economic activity. That transparency is really important, both because investors want to know what possible contingent liabilities governments are carrying, okay? And this is a global phenomenon. It's not necessarily just this region, but divestment, where the state does really not need to be involved in economic activities. I would think that is relatively low-hanging fruit, okay? And finally, coming to all of this should, in principle, at least make attracting private sector investment, including foreign private sector investment, more conducive, okay? And finally, I'd say, this is slightly longer term, but it's all on all our minds, is how is every region going to address climate transition or net zero, okay? The one thing we will all agree on, whether it's this region or elsewhere, it will require a lot of private money, okay? And if we're going to take net zero seriously, and attracting private money will involve what you were saying earlier, is developing capital markets, but it also involves making economies attractive for private investment. Okay? Now that's not low-hanging, but it's important.
Thank you. Jihad, just to kind of wind up this part of the session before we get to the Q&A, you've just listened to your esteemed panelists here discussing their perspectives on the outlook for 23-24. The risks to the outlook, you have said, are tilted to the downside. You've said stemming primarily from the financial sector instability in advanced economies, tighter for longer global financial conditions, and an escalation of the war in Ukraine, the elephant in the room perhaps that we haven't discussed here, but I think it is important, just before we get to the Q&A session here, to get a sense from you of how an escalation of this conflict may actually detrimentally further affect the economies of this region.
Well, let me first say that I very much feel that we are all converging on both the issues as well as also the policies, and the importance of having a well-thought policy mix and move fast. And this is to answer your question on the war in Ukraine. The war in Ukraine has two types of effects. You have the direct impact, which I think we have already felt those, and countries have adjusted to. Increase in commodity prices, reliance on commodity on Ukraine, Russia, etc. Countries have already adjusted to that. The second impact, which is the indirect impact or the global impact. Here, one key issue that keeps rising is the risk of fragmentation. We are seeing a world that is getting more and more polarized, tense, and we are a bit at the juncture between the East and West. Therefore, this polarization is an issue that needs to be internalized and then addressed.
Can I just pick you up on this point? Because I think there are countries in this region who won't see that as a risk, but as an opportunity.
Well, you are, in fact, reading in my mind, okay? But let's start first with the issues that may come with that. The issues that may come with that is lack of global coordination on policies and the impact of that on some of the macro trends, including capital flows, including the fluidity of transborder or cross-border payment, issues on even the commodity markets, the oil market. Therefore, there are certain number of issues that we need to address. In terms of opportunities, clearly the world is changing, and I see at least three that the region can benefit from. One, that is a low-hanging fruit. We see greater interest to invest in the region from those who have excess reserves. Gulf countries, through their sovereign wealth funds, have dedicated resources to invest in other parts of the region in terms of foreign direct investment. This is an important move. Over the last decade, we saw a decline by half of FDIs in the region. This could be a game changer and then will bring a new dimension of regional cooperation. This is one, and it's important. We have at least $30 billion aligned in terms of investment. The second is we see in terms of value chain, what we call friendly shoring or reshoring, certain number of countries who tend or are able to benefit. Take the case of Morocco. Morocco is a country that has developed over the last decade or so their capacity to be part of the global value chains. And now they see more demand coming from Europe. They see also capacity because of the cost of transportation to become more competitive. You can apply this even to basic things, agriculture. Therefore, this change in the way the global trade has been moving over the last few years is important. And the third dimension, I think Mahmood alluded to it, is climate. Climate is an issue, but this is something that is going to require huge set of adaptation or financing of adaptation that the region will benefit from. To the region, the last two COPs took place in the region, in Egypt last year and this year in UAE, and there is a resolve to increase financing transition.
Sure.
And this is also one area where you have already in the region, take the case of Masdar here in the UAE, the second largest producer of renewable energy. This is a potential of growing a sector that will make benefit in terms of strengthening the recovery. I think, again, macro is going to be very important because macro stability matters, and macro stability drives positively or negatively the capacity of countries to compete, but this is not enough. Increasing the ability of countries to become more productive and more competitive, reforming the public sector, redesigning the role of the state, and this applies for all exporting and all importing countries in different ways, allowing the private sector to flourish further through access to finance that remains low in the region, through access to talent, which we saw the results, change in certain regulations, take the case of UAE, allowing women to work, has improved output, reduced unemployment, and increased the level of women participation in the economy. We should not underestimate those reforms. We should not underestimate, and I will conclude with that fiscal is very important. Not only in terms of raising revenues, but also in terms of leveling the playing field, reducing some of the special regimes or exemptions that divert the way economies work. And in some of the emerging economy, this is the best way by improving predictability, reliability of your tax system, where you can attract FDIs.
Thank you. And with that, I'm going to conclude this part of the panel. Thank you very much indeed. Your insight has been absolutely invaluable. We're going to spend about half an hour now just doing Q&A. So I'll take questions from the floor here, and I will take questions from those of you who are joining us around the world. I've got a number of hands up here, so let's start off. Name, organization, and question. If it's specifically to one of our panelists, please make that clear.
Hello, my name is Dania Sadi. I'm a reporter with S&P Global Commodity Insights. I have a question for Dr. Jihad in terms, in the report you mentioned that the break-even oil prices for the GCC in particular are still high. And that's, I just wanted to double check if that's before the voluntary cuts or after the voluntary cuts. And also, how's that going to impact the countries? Because you said the voluntary cuts might stabilize the prices. But if the countries still need high spending to diversify their economies and boost non-oil growth, how's this square with their ability to manage their energy policy at the same time have lower break-even oil prices? Thank you.
Thank you. Jihad.
Thank you very much. Thank you very much. This is a question that we have been debating this morning at the press conference. Yes, the projections, as also I answered Becky in the beginning, were done before the recent decision by OPEC Plus in terms of cutting production. What do this mean for the break-even price? Of course, it depends how prices will evolve, because the break-even price is, or the impact on the fiscal is related to the level of cuts. And this is where, for example, certain number of countries have higher impact, like, for example, Saudi, because they have bigger cuts. But I would say what we saw over the last few years is something that goes in the right direction. We see diversification of revenues outside oil in order to be less dependent on the oil prices in order to determine the fiscal stability for those countries. We see something that is also equally important is anchoring policies, especially on the fiscal, on the medium term, which provides also the capacity for some flexibility while giving the right direction. Of course, oil exporting countries are not equal. Some have buffers and therefore have better access to markets and have reserves that they can use for their investment projects. Others have less, and those we recommend for those to maintain the consolidation and make sure that any volatility in the oil price or change in the direction of the oil market will not affect their macroeconomic stability.
Anybody else want to pick up on that?
So we've done a bit of work on break-even oil prices as well, and our view is that our estimates are actually a little bit higher than the IMF's in terms of what the break-even oil prices for the region are. But overall, when you look at the change from 2022, we're now expecting lower oil production and lower oil prices. So the impact on the budgets in the GCC from our view is going to be negative. That's not to say that the budgets are going to move into deficit necessarily, but the surpluses that we saw last year, the accumulation of reserves, the paying down of debt, that's probably not going to happen to the same extent in 2023. There are a couple of countries where we now do think there might be a marginal deficit on the fiscal side, but by and large, the balance sheets in the GCC countries are much stronger now than they were 2 years ago, and we do believe that there is financial firepower to finance the big projects that are underway over the medium term.
Thank you. Question there.
Thank you, Becky. Amena Bakr from Energy Intelligence Group. I'm the chief OPEC correspondent. Mr. Jihad, I just wanted to clarify something. With the OPEC cuts again, do you believe that it adds volatility to the market, or does it add stability to the market? I mean, we've seen statements from the IEA, for example, always warning that these cuts are going to drive the economy into a recession. And I have another question on the transition. Just given that the energy transition requires a lot of funding and finance, which you've also mentioned, isn't the Middle East better placed, especially with the GCC states, to drive the transitions as opposed to other regions such as Europe? Thank you.
Thank you. Shall I take a couple of questions from the floor? I want to take one from you, sir, and then one, hand up there at the back. Let's take these three. Coming back to you. Big voice. No, here we go.
Hi, my name is Omar Hafiz.
Keep it short, please.
Yeah, absolutely. I'm responsible for North Africa, Levant, and Central Asia at Citibank. Question is really around capacity with all the leverage in the system. Debt for climate swaps, something that IMF has spoken about. Is that something we're going to see more aggressive movement on in the next COP?
Thank you. Yes.
Good morning, Bhavesh Dattani, a financial regulation partner at the law firm DWF. My question's to Ebru.
Speak up.
Notwithstanding the challenges in the US around the banking system, which, as you mentioned, had limited impact here, do you think there will be a tightening of prudential regulation which will impact investment appetite of financial institutions, both on the asset and liability side?
Thank you. Who wants to start? Do you want to start with that last question there? Yeah.
Sure, let me do that. I think the short answer is yes, but we can obviously calibrate that. I think for all of the financial service regulators across the globe, systemically important banks have been of a significant focus over the last 2 decades. And a lot of steps have already been taken in terms of the practices, the disclosure requirements, the capital requirements, the buffers for capital as well as liquidity. So I think for that segment, and to the extent that different regulatory authorities have already been thinking about some of those measures, perhaps there may not be so much more change. But the level playing field or the type of regulatory framework that should be applying much more broadly across the financial services industry, and that's not only banks, it is also other financial institutions and increasingly more of the non-bank financial institutions, which needs to be considered. I think we will see increasing prudential regulatory authority and changes and some tightening, which will obviously play out differently for every financial institution in terms of their own investment appetites.
Thank you. A question on credit swaps, and from Amina, a question on OPEC plus production cuts, Jihad, and on MENA, very perhaps more specifically GCC, climate funding and financing. Do you want to put that up?
On the OPEC plus question, I think we are forgetting one important dimension, which is the demand. The demand is driving currently more where the oil market is going. And here there are a certain number of uncertainties, how fast and how strong the recovery in Asia is going to be, and also what will be the level of growth if further tightening are to happen. Therefore, I think we need to take into consideration the impact of demand on the market. The OPEC plus policy is to stabilize prices, and therefore they are ready to adjust production and export in order to maintain prices within a corridor. And this has been, at least looking at what they have decided over the past couple of years, this was the main driver of the decisions to increase or to cut productions. The transition question, I think the transition question is something that is relevant worldwide. For the region especially, you have oil exporting. It has an impact both on the energy security side and on the energy transition side. It requires huge set of investment, and the region has resources for that, has started. But again, here we see a certain number of changes happening worldwide. There is a kind of a competition between Europe and the US on who would invest faster or who would provide more incentive to that. We need to take this into consideration. Those are long-term trends. Those long-term trends will also involve private financing, and I look forward to hear from those who are sitting on the panel, who are, I would say, the one who will finance all this, to share with us how they see both the credibility of those plans that are currently taking place and what could be the role of the private sector. For us at the fund, this is an important priority. This is a new, I would say, area for us whereby we consider climate as macro-critical, and therefore we believe the fund has a role to play, a limited role, a role to allow, I would say, to accelerate this transformation and through the role or the involvement of the fund to entice private sector and private financing to be, in fact, helping in this important plan.
So I think it is important to open this question to the floor then about the credibility of these plans to better involve the private sector. And you hear this from Dr. Sultan Al-Jaber. We heard it from him yesterday in Berlin. It has to be that both the public and the private sector are at the table, and there has to be a significant step up by the private sector in the activity of funding and financing climate. Before I do bring both of you in, perhaps, I'm not going to let you off the hook there. Amina specifically did ask you whether, you've talked about stated policy of OPEC being to stabilize prices, stabilize the oil markets. But she very specifically asked whether you believe the actions that they've taken have created or will create more volatility.
I have learned the lessons that it's very difficult to predict how the oil market moves. We saw over the last 5 years prices of oil at $20 or less and $110. Therefore, I am humbled with how volatile the market is, and I will not adventure into this these kind of predictions.
I tried. I mean, I tried. Can we just, let's talk about the credibility. It's a very good question from Emma. The credibility of these plans to significantly ratchet up the involvement of the private sector in climate financing and funding.
Happy to kick off. So I mean, credibility angle is really interesting. And again, if we just step back and we think about climate financing in general, transition is a very, very big topic. And for the emerging markets that we are sitting in, especially if we broaden out the emerging markets and start thinking more Africa and sub-Saharan Africa, there is obviously investments that needs to go into a lot more basic needs around ESG, whether that's on the social side, whether that's on food security, whether that's on basic power and electricity, quite honestly. So we think a lot about how those economies are actually going to be transitioning and what their needs and expectations are going to be, and can you really move from oil or hydrocarbon dependency to the complete renewables, and what type of transition you're going to have to go through. So I think articulate plans around how that transition is going to happen over the next 20 years, the government policy is backed up by actual execution plans, and that's the name of the game here when we talk about credibility. The actual execution plans of how that's going to be achieved is going to be very important for the private sector to sit around the table. I think that the third stool of the leg that we need to really, third leg of the stool that we need to think about beyond the private, which is the financial institution financing, and the public, are the multilaterals. Multilaterals can play a very, very significant role in all of this. And the policies and regulations which are binding the multilaterals, whether those are the ones supported by the World Bank or otherwise, Exim banks, etc., they need some reforms in terms of being able to come into these very long-term projects and programs and actually support the financial sector.
And you are not the first person to call out the multilaterals, let it be said. And there is clearly some very definite reform that needs to be had. Mahmood, let me bring you in here.
I mean, I think from what the public sector can do, we need to think about some concrete things. Yes, it is a very long-term transition. The first is you have to incentivize green investment. You have to incentivize investment in renewables. Okay? I think that's a prerequisite. And how you do that is you have to disincentivize the use of fossil fuels, carbon taxation, something. It's a very difficult thing to do, but it's going to be necessary to incentivize investments. Secondly, there is a lot of demand for ESG labeled investments. Hopefully we will get over time. We are getting better at dealing with greenwashing and labeling and so on. We will get over that. ESG criteria are getting firmer, we're getting stricter. Compliance with ESG is getting stricter, particularly in Europe and the EU. There is a lot of demand for ESG investments from asset managers, from all kinds of stakeholders. It just needs the right incentive that if you can make green investment financially attractive, then it can happen, and that requires the public sector to play its regulation role. Secondly, in terms of multilaterals, particularly for the development banks, I think it's time for them to take more risk in this area. I think they've been particularly conservative. I'm not talking about the IMF here. I'm talking about the development banks, the World Bank, the IFC, etc., the European Investment Bank, and institutions of that ilk. They could take a lot more risk with, and particularly with public-private partnerships. Okay, thanks.
You absolutely can, Jihad.
There are two dimensions that I want to underscore and highlight. In terms of financing, I would say the majority of the discussion and the effort today is in providing debt financing. I think we need to promote further equity financing and mezzanine financing in order to provide the full spectrum of financing opportunities. The second is there is an effort to be made in terms of how to price assess the risk, because at the end of the day, financial industry is also about risk management. And I think this is something that is very important to do. The last point is some of the climate investment is to address the issue of adaptation. And this is mainly in the case of emerging economies. And here there is a role, or there is more from an institutional money to be provided to those. And I agree that the role of institutions like World Bank, regional development banks should be stepped up in order to help countries who are not large contributors to carbon emissions, but they are in fact the first to suffer from it. And they may not have the resources, especially that is becoming very expensive, to be able to finance it. And last is we see a kind of a divergence currently in terms of, I would say, the policies. Europe is still considering that pricing carbon is the right approach. The US considers, or at least the impression we have, that providing incentive to accelerate transformation is the right approach to have. I think we are going to converge somehow, and the architecture will be clearer in terms of who are the actors, what are the policies, and where institutions who are on the multilateral side should come in order to boost with the private sector this transition.
They're running out of time if they're going to reform themselves, by the way. I mean, it needs to happen now. And we've got a first ever global stock take this year. And I think it will be very, very clear that things ain't looking good. So, I mean, if we're looking at reform of the multilateral banking system, then we need to see it now. I've got a number of questions here. One, yes, sir, blue shirt here. Promise you've got a microphone already in your hand there. A couple of other questions coming in here. So let's take three questions.
James Drummond from Arabian Gulf Business Insight. I'd like to ask Dr. Azour about Egypt and about the state of negotiations between the IMF and the Sisi government. It seems that the review is overdue, and it looks as though the Egyptians haven't implemented one element of the reforms demanded. Could you comment about the timing and what the state of play is, and perhaps also on the very many other programs you have around the region, as I understand it, Morocco, Jordan, Lebanon, and Tunisia. There's a slight air of unreality, isn't there, in this room about this? There are serious problems with many of the poorer states in the Arab world, and we haven't talked about them at all.
And we had promised that we would talk about them in this Q&A session. I also want to, I want to ask you about Sudan. I want to get your perspective, please, on Sudan very specifically. You in the review looked at a low-income growth story of 1.3%. Fragility, you say, dominates low-income countries' outlook, protracted conflict, Yemen, drought, Somalia, renewed conflict, Sudan, and then the issues that you've just brought up of Lebanon, of Egypt, of Tunisia, and various others. So hold that thought. Egypt, question from the audience here. Sudan from me. Yes, sir.
Yes, good morning. Ron Alon from Borealis Brokers, LLC. The question is the following. We know a lot of the countries in this region have their currency pegged to the US dollar. On the other hand, we have Russia and China, a lot of movement happening there, and talks worldwide about potential transactions of oil starting to happen in a different currency, not the US dollar. How would that, or how do you see that impacting this region, where many of the stronger economies in the regions are actually pegged to the dollar?
Thank you. And I think there's a question for everybody here. What prospect of the decoupling of the dollar, and if so, what impact? Let's take one more question, please. Yes, just here. Here.
Thank you. Daniel Calderon from Alcázar Energy. We're an investor in renewable energy in the region, a private investor. In 2013 and 2014, following up on the Egyptian question, we also saw difficulties. 2013, 2014, IMF came, you agreed the program, and then we had 7 years of very healthy investment in Egypt. They built some of the region's leading portfolios of renewable energy. Today, it's tough again. I think what our investors want to know, and there are people like Allianz and other insurance and pension funds from Japan, Europe, North America, what they're asking me is this time structurally different, or are we again looking at a process where we can recalibrate, agree to a program, and go back to investing for another 7 years? Or is now very different fundamentally from the way it was in 2014 when you guys agreed this program that worked so well? Thank you. Thank you.
Very good question. So let's start with Egypt and whether, how things have changed since 2013, 2014. There's a question from clients, from investors wanting to know where you are at and what's the perspective on that. Let's take a bit of a whip around the region after that and just find out where the IMF is at on some of these other country-specific questions.
Thank you very much. Egypt, let's take one step back. Over the last 5-6 years, Egypt did important reforms that yielded good results. Growth went up. Attractiveness of Egypt in terms of capital flows became one of the most salient one in the region. But I think what we have learned recently, it's an old lesson, is when things change, policies need to adapt very quickly. Therefore, what is the program, the current program is about? One is to protect Egypt from external shocks. And this is why moving to flexible exchange rate regime that provides credibility to market, that allows Egypt to be less affected by external shocks in a shock-prone world is important. This would require to have the full mechanism of flexibility applying and market determining where the exchange rate is. Monetary policy should address inflation because inflation has been stubborn in Egypt and requires to be brought down. And this would require some monetary policy tightening, synchronization of policies, making sure that on the fiscal also, it's not affecting the impact of monetary policy. 3 is to reposition the Egyptian economy. This economy can create additional foreign currency, can be more export-driven. For that to happen, you need to recalibrate the role of the state, have the state more becoming an enabler, and exit certain activities where the private sector can be on the lead, leveling the playing field between different form of companies and between external and local investors, because the level of FDI has dropped over the last few years. This is, I would say, and the last element is, which has started already over the last few years and it's progressing well, changing the pattern of spending in order to be more targeted. This is where we are today. The program has been enacted. The program has catalyzed additional support regionally and internationally. And the good news is part of the support is in terms of investment, in terms of FDI. We are in current discussion with the authorities on how to progress on the implementation of those reforms. It's a 4 years program. It's not I would say, 1 year or two.
Are you concerned about progress?
No.
On any one point?
Look, again, we are at the beginning of the program, and at a time where uncertainties are high and shock are becoming more frequent. Therefore, what is needed at this stage is to make sure that the objectives of the program are translated into the steps that currently will bring market confidence back, will bring investment forward, and also will allow some of the issues that could derail the macroeconomic stability, especially inflation, to become under control. Jordan program is progressing, and I would say Jordanian implementation of the program proved that when you have the right policies and you implement them at the right time, the market rewards you. Jordan with Morocco were the two countries who were able to access market in 2023 at good rates. Although the debt of Jordan is high, but the credibility of the policies, including on the fiscal side, on the revenue side, paid and paid back positively to Jordan. Lebanon, the issue is there are a certain number of important steps to be made for the program to be enacted. Those needed measures for the stabilization of the Lebanese financial situation and to move forward are taking time. Tunisia, we have staff level agreement that is also still need few steps. One of them that was completed is to align the financing for that, and this is something that we have secured. There are still few steps.
Is the president in Tunisia standing in the way?
Well, the issue of making sure that some of the measures are not hurting the low-income group is also something that is very important to us and in the program. We are working with the authorities to make sure that the program that they have designed in terms of social protection is able to cover for the shift from a very, I would say, regressive subsidy. The last decile of the population in terms of subsidy on energy is getting equal to the first 9 deciles. If you put fuel in your car, 50 liters of gasoline, you get a check from the Treasury of $20. Therefore, if you shift this toward maybe direct support or better support to the low-income people, you will improve on social protection without hurting the fiscal situation.
Thank you. You did push through Lebanon quite quickly, and I have to, I'm going to, with respect, have to just have you just address Lebanon a little more deeply for a moment. In 3 years, you have just suggested there are still things that need implementing. Let's be quite frank, everything that the IMF, effectively everything that the IMF asked for, nothing has been achieved in Lebanon, and things have gotten a whole lot worse. Are you the man for the job of president, Jihad, to take this country forward? I mean, that's not the primary question I want you to address, but I think it's certainly an important one. You know, the US and others have said we simply need to see a leadership free of corruption in order to provide some sort of stability for trust in the Lebanese infrastructure and economy. Let's just back up. How concerned are you about Lebanon, and is this a job for you?
Well, allow me not to answer this question, at least the first part of it, and not to comment on it. On the second part, yes, this is an economy where inflation has been now in the triple digit, and the national currency has dropped dramatically, which pushed people into poverty. This is an economy that is not able to recover because of not dealing with some of the important issues that can bring confidence back, stabilize the situation. I would like to add, this is also one of the lessons we see in the region, is when you delay some of the important measures, you will have much less impact. And the hurdle that you need to address becomes much bigger. And this, in this current juncture, where uncertainty is high, appetite of investors is very challenging. Most countries in the region, especially the emerging market ones, those who have high level of debt need to have the resolve to address that. For certain countries, only by the increase in interest rate, you have 1 to 3% of GDP additional deficit for that. And this is very precious resources that you can deploy for helping your population. You also raised the question of Sudan, and I would not want to end without, saying 2 words on that. This is a very sad story to see a country going through this level of suffering, and that an aspiration 3 years ago of reform and recovery to end in what we are seeing today. We call for the hostility to stop and to focus the energy on how to help those who are extremely vulnerable and who have made even more vulnerable for that. We at the fund, a year and a half ago, we were hopeful. We had the largest debt relief operation in the history of the fund, $65 billion, that would have allowed Sudan not only to, I would say, to come back into the region, but also to be able to finance development. Sadly, what we are seeing today is something that will push Sudan back, and we are also concerned about the impact of what's happening in Sudan on neighboring countries.
You will hope that this current declared ceasefire that is set to start tomorrow will last. We've run out of time, but not before, and I promised to put one of the questions from the audience here. I'm so sorry, I know that there are so many other questions, but we're going to have to wind this up. But the question on decoupling from the dollar, I think, is a really important one, gives everybody a chance to just sort of, weigh in what is this last, let's say, 90 seconds. So 45, 60 seconds each. Small question, easy question. I know you'll have your elevator pitch on this. Go.
So I think for the GCC, the key point to remember is that it's an oil exporting country that runs a current account surplus, and so they're accumulating dollars because that's what oil is sold in. It doesn't really make a lot of sense to settle trade in a currency where you're going to be accumulating reserves that are not necessarily easily convertible. And at the end of the day, you have to pay for imports from other jurisdictions, so you need to make sure that you are able to have the flexibility to pay in whatever currency you need to. So the short answer is I don't see it as something that's likely to be a big factor going forward in the region.
Okay, you set a precedent there. That was about 45 seconds. Well done. Thank you, Mahmood.
I mean, basically, I'd agree with that. I'd just make a slightly more general point that I think in all this conversations in geopolitics or geoeconomic fragmentation, question marks about the dollar, I think we should split up 2 things. One is what you use in transactions, which I think is completely separate from where you hold reserves. And I don't think the dollar's role is changing at all in terms of where people are holding reserves. That reinforces that point. And secondly, even where you see some question marks about large reserve holders diversifying, that is completely natural. That just means they've reached a point where they're holding way in excess of what they need. And like any portfolio manager, you then need to reduce your concentration. And finally, I think a lot of the current data that looks at changes in dollar holdings does not fully account for valuation changes, which is to do with US interest rates rising, US Treasury prices falling, etc.
Ebru, thank you.
My views are very, very consistent. So, I mean, in the interest of time, I won't repeat everything that has been said. It's very consistent in terms of commercial and trading ties are clearly increasing between GCC countries and many Asian markets, but that's very good from a diversification perspective. That just makes a lot of sense. That doesn't necessarily mean, though, any economic ties about US dollar is going to be changing anytime soon. Our research suggests very similar results to what my colleagues talked about.
Thank you. I have been told that we can take just a couple more minutes, so I have got time for a couple more questions. Sir, at the back there, yes, in the pink tie as well. I've seen your hand a number of times, and yes, at the back. So we'll take these 3 questions, if that's okay with you guys. Thank you. Yes. Microphone, please. Hold on. Right. First from you, sir, and then you can share the microphone.
Good afternoon. Ahmed Zakaria, Head of Financial Services for the Emirates National Oil Company. My question is regarding your answer, Mr. Mahmood. So with the advent of a lot of OPEC producing countries progressively trying to join BRICS, and if BRICS sort of has a stabilized currency in the next future, what impact will that have on the US dollar?
Great question. Jihad. Mahmood?
Very sorry, I didn't understand I didn't hear the full question.
So your question is, so what you've seen a number of OPEC plus countries looking, well, ask the question again.
Yeah, so there's been a lot of talk recently that a lot of OPEC producing countries may eventually join BRICS in the future, have submitted applications for that. So what is the effect of that in the future if they do start trading in other currencies or hold reserves in other currencies? And eventually a BRICS currency does, happen in the near future, or stabilizes, what will happen to the dominance of the US dollar?
So I think the idea, understood.
I don't see that arrangement, the expansion of BRICS to a larger group, changing the role of the dollar. I just take you back to 20 years ago when BRICS started as a group, or BRICS the label started, right? That hasn't changed the status of the dollar. I still think that really what matters is if we can separate, and I think we are, separating transactions, what people settle transactions, trade transactions in, versus what they hold as part of their reserves. And I don't think that is changing. Thanks.
Thank you.
Sorry, hi. I'm Anand Sharma from Premier Advisory. We are a boutique advisory. My question is on the ESG side of it. What is the potential to spur, enhance, and get more commitment on ESG for the likes of IMS, EBRD, ADB, etc., to go and identify smaller units that may perhaps be near non-performing due to lack of funding or due to lack of other resources, and energize them and bring them on in national, regional pool of direct visibility for their enhancement to contribute. Because this clearly is not something which a global corporate is going to take beyond a point only to do ESG. It's got to be a collective exercise, starting from the grassroots up.
And last question. Why did I say yes at the back, please?
Good afternoon. This is Rawat Taha from LBCI TV station in Lebanon. I know we tapped briefly on Lebanon, but I have a technical question. It's been officially more than a year since the staff level agreement has been signed. At what point would the country need a new staff level agreement, or the staff level agreement would officially tend to expire, or is just not a viable option anymore? And adding up on top of that, with the current lack of policy making and what some people are calling a shadow plan, what is the prospect for Lebanon without the implementation of the staff level agreement?
Well, the technical question, but an important one.
Thank you. Very quickly, the staff level agreement has been signed a year ago. Recently, we had Article 4, which is a surveillance mission that looked into the status of the economy. And clearly, what the analysis is showing that what is still needed for Lebanon to, A, address the legacy of the past, stabilize the financial system, address the issue of hyperinflation, and do the structural reforms is still valid. And therefore, what is in the staff level agreement is still the right roadmap to start the process of economic reform and transformation in Lebanon. And this roadmap and this platform could also capitalize, or one could capitalize on it in order to attract additional support from the region and from the world. Those measures are needed with and without program with the fund, and therefore we encourage the authorities, we press the authorities to accelerate in the implementation of those needed measures in order for the process to start.
Thank you. And on the ESG, do you just want to pick up on the...
Well, to be honest, we need that question to be repeated because we haven't quite understood what the question is. I don't know.
Right. I think that, yeah, do you just want to make the question a little clearer?
The sound was a bit muffled. So.
Yeah, it was rather muffled. I would have helped you out, but I was struggling to understand as well.
My apologies.
Keep it very concise.
Very concise. So going back to the question, it's on ESG and it's on the measures that IMF, EBRD, ADB, any multilateral development bank can support ESG at the grassroots, particularly enterprises which have gone into ESG and are perhaps near non-performing and their revival.
I'm gonna say that microphone is not working. That's still pretty muddled. Unless you could, yeah.
I think the question is about what the multilaterals, EBRD, and others could be doing to support ESG initiatives.
For the revival of non-performing, potentially non-performing ESG enterprises at the grassroots levels.
Okay.
Microphone.
So, look, I guess very briefly what I would say, and Mahmood touched upon incentives and disincentives. I hope I'm answering the right question, but I mean, in my mind, disincentives is not the solution. Incentives has to be the solution, because disincentives is neglecting the need for transition, whereas incentives, and whether that's how one should be thinking about risk weighting of capital or any buffers that needs to be built for ESG-related investments over what period of time, those are some of the things that can be improved in the regulatory framework and the likes of EBRD, and that's why multilateral reform is important, because today in their own toolbox, they have limited tools to deal with non-performing loans or very long-term assets. Those are some of the reforms that needs to happen for the likes of multilaterals to be able to actually extend much longer term and less clear risk calculations, which is all things that still need to be defined. Again, Dr. Jihad touched on that again. How do you think about the risk of execution or risk of some of these projects? There is still a lot of work that needs to be done in the industry around that. One final thing I want to add on ESG, because I realized we didn't, maybe we didn't mention that, it's not only the energy or environmental or social side that needs to be solved for, it's also the infrastructure that needs to be built out. Because if the renewables are perhaps being developed as part of a project, what is the infrastructure, what is the supply chain, what is the distribution mechanisms that will be available to be able to actually get those new forms of energy to where they need to go? And in many of the countries where this could be an opportunity, there is a huge need for infrastructure, whether that's railways, roads, ports, etc. And there is that angle that still needs to be also solved for in addition to ESG.
Thank you. Great effort. And thank you for all of the questions, for your attention today. Thank you. This was fascinating. We are absolutely delighted that you could join Jihad today. And Jihad, thank you very much indeed for the deep dive on the Middle East and North Africa Regional Economic Outlook released today. To all of you, we look forward to seeing you again in Dubai at some point. But for the time being, we thank you very much indeed. Thank you.